Dan loves tech. Dan, good to see you. Don't know where to start, so I'm going to start on Nvidia. I mentioned at the top, we're seeing the bulls return to Nvidia. Not in a big way, but I would say in a nice way. What's the play there?
Look, I think the reality is China's going to reopen, for Nvidia, and I think that's something that wasn't necessarily factored in fully. I think investors are realizing it's a big change in the beltway. And look, Saz, the reality is there's one chip in the world fueling the AI revolution, and that's Nvidia. And I think as it plays out, numbers are significantly underestimated. I think 15 to 20% at a minimum going in 2026. You put that together, I think we're looking at a $250 stock in a base case to end 2026.
Another case for Nvidia, Dan, is it this? And you can tell me if I'm wrong. You and I have known each other for many, many years. It's okay. We have a debate here. That Nvidia has less exposure to OpenAI than its rival AMD, because AMD might be partially owned by OpenAI in 10 years.
Look, right now the reality is that associated with OpenAI is a bad thing. Now I disagree with that. You've talked about it, but no doubt from a trade perspective, Nvidia, they're obviously they're not wed to an OpenAI, and I think to some extent, I think you've talked about it. When you look at the divergence of those related to OpenAI, whether it's Oracle or Microsoft or whatever it may be, those stocks are obviously under more pressure. But look, my view is as we go into 2026, investors are underestimating the scale and scope of the AI revolution for Nvidia, for OpenAI, for Oracle, which I think is table pounded here, despite obviously a lot of the negative sentiment for Palantir and others. Because look, only 3% of companies in the U.S. have gone down the AI path. And for the first time in 30 years, the U.S. is ahead of China when it comes to tech.
Dan, later on in the show, I'm going to have Marianne Bartels on. Really excited to talk to her. She's making the case that tech might see, her words, not mine, a reset year next year, but then go off on a very strong bull run looking out over the next decade. If there is a reset in tech, let's just say the first quarter next year, what triggers that?
Yeah, look, and she obviously always has great thoughts. I think my view is, look, the white knuckle moments, whether they're resets or whatever you may call it, they create the opportunities. I mean, go back to, we'll be at CES again, go back to a year ago, right? I mean, Jensen comes out, the black leather jacket, I think even maybe potentially diamond studs in the back or whatever. Talk about quantum.
I think that's your jacket, Dan. I think that's your jacket.
I think that could be your jacket, Davos. But we're getting off topic. But the point is, look, the reality is negative on quantum. Remember the sentiment, going to DeepSeek moment in January. You're going to have these moments, but my view is you're in year 3 of an 8 to 10 year build out of the AI revolution.
Outside of Nvidia, I love what some of the thoughts you've been putting on your X account, Dan, on Tesla. Now, I'm sure you saw the photos of Waymos getting stuck in San Francisco with the power outage, and my first thought was, this is everything that could go wrong with the Tesla robotaxi.
Look, my view is 2026 is going to be probably the most important year, I'd say maybe in its history, for Musk and Tesla. Because, look, the autonomous chapter now comes to Tesla. 30 cities where we see robotaxis, ultimately in the United States. Are there going to be issues? Are there going to be speed bumps? Could there be delays here and there? Yeah, I mean, obviously you saw the blackout in terms of Waymo in San Francisco. But look, I think next 3 to 4 years, 20% of vehicles are going to be autonomous. And I think that ultimately is where it's heading. And that's why I think when it comes to physical AI plays, the best physical AI plays in the world are Nvidia and Tesla.
How much value, Dan, are you assigning to Tesla's robotics initiatives?
$1 trillion is what conservatively we view. I mean, look, if you own Tesla here, you're not owning it for what deliveries look like on Jan 2nd, right? I mean, you're owning it for autonomous robotaxis. And we talk about bull case 3 trillion, base case 2 trillion. Now, look, if I showed you a year ago where numbers were going to go for Tesla this year, you'd be like, the stock's $250. The reality is that investors are looking through deliveries and near-term numbers to understand what the autonomous chapter is going to ultimately bring. Because I could argue numbers could be up 4 or 5x when you look out over the next 3, 4, 5, 6 years. I think that's the way to view a name like Tesla.
Dan, before I want to get to Palantir, but why I love you, and many reasons why, as you know. But one is you cover damn
I
near
love you.
you cover damn near everything. So if Tesla's going to dominate in robo-taxis, what does that mean to a General Motors and a Ford, who are not really playing in this industry at all?
Well, first of all, to lump GM and Ford together, I disagree. I mean, I think what Mary's done and Paul at GM has been Hall of Fame moment for them, right? The stock, I think, speaks for that. They've been able to navigate supply chain issues, pull back on EVs, but I believe like GM is in a much better situation. And again, they're going to kind of pick their spots. Ford obviously much more back against the wall, and we see that in terms of what Farley's trying to navigate. Look, I think what it means for the GM and Fords, they got to pick their spots. They got to figure out how they're going to go down the autonomous chapter. Do they eventually partner at one point with Tesla? I don't think that that's out of the realm, given where we see the autonomous world heading.
And Dan making some good points here. General Motors shares up about 56% year to date. Ford about 35% year to date. They're just coming off a big, almost 20 billion charge to their EV business. Dan, so on Palantir, I know you're watching this name. Is Palantir double next year? And if so, why?
I think it's $1 trillion market cap next 2 to 3 years. I think investors are underestimating how disruptive Palantir is on the enterprise. They've just started to tap into that market on the commercial business. So no, look, is it super expensive? Of course. But if you look at next 3, 4, 5 years, like I view it as like it's going to be the next Salesforce, the next Oracle, however you want to think about it in terms of on the software side. And I think Karp's playing a different game. He's playing chess as a mastered wizard. And I think a lot of others are playing, checkers at the kids' table.
I'm loving this comparison or this duel that erupted in the fall, Dan, between Mark Benioff and Alex Karp, kind of taking shots at the other out there in media and X, I believe. If Palantir is a winner, then is Salesforce a loser?
Look, I don't think Salesforce is a loser because I believe Benioff's going to be able to turn this around. Agent 4 needs to be successful. They're probably going to have to do more acquisitions. But no doubt, look, Benioff, top of the mountain, the Hall of Fame, Mount Rushmore CEO. But for the first time in many, many years, I won't call it a code red, but there's a threat to the business model. And I think they have to adjust. And that's why when you look at Palantir with no direct salespeople doing what they're doing, I think that it's a shot across the bow, not just at Salesforce, at ServiceNow, Workday, traditional software.
Dan, hit me with a tech stock you hate.
Look, Adobe's the one, I wouldn't say hate, but Adobe's the one that's probably under the most pressure, given you think about AI, what it's doing to their business model, what they need to prove. Massive success story, obviously, over the decades. But I think when you think about AI as a threat to a business model, I think Adobe, look, they're going through a turbulent little white knuckle period here.
Yeah, we're not going to be printing out PDFs anymore, right, Dan?
Look, they got to change. They're going to have to adjust and change part of their business model. But I mean, look, it's no different than Salesforce, no different than Workday. I mean, these are companies you either pivot or stay on the treadmill at 2.0 speed.
Lastly,
right?
Dan, this may be the last time I see you this year. And if it is, you've been traveling around the world all year, meeting with investors, covering this tech AI revolution. What has surprised you? Is there one thing that has absolutely blown you away this year?
Look, I think the thing that's maybe surprised me is just what I ultimately view as the enterprise adoption and how accelerated it's been. Go back to CapEx a year ago, right? Concerns about AI, big tech CapEx, and it's ultimately 50% higher than ultimately it was at the beginning of the year. I think that's ultimately the thing it's that acceleration that surprised me the most. And maybe the other surprise, obviously is I was hoping for more from the Giants and Penn State, but what are you going to do? I mean, we got another year next year.
There's not much you can do, Dan. Sometimes we're just at the whims of bad decisions by our sports teams. Dan Ives, happy holidays to you, my friend.
You too,
Thanks
man.
for making time, man. Appreciate you.
Big picture, is your screening or kind of your framework changing, if at all, for 2026?
Well, I know I'm not the only one to say this. Hard assets, of course. I mean, we're seeing what's happening with the metals and how that's going to matriculate into other hard assets. So I have not discounted agricultural sector, which has been under a lot of pressure, but yet we're seeing some nice moves this morning in soybeans, for example, sugar back at 15 cents. I think you have to keep your eyes on all of that. And you can look at DBA, which hasn't necessarily broken out, but has potential. Also oil. I mean, right now, everybody in the world seemed to be so bearish based on an oil glut, but yet here we are almost at $58 a barrel, not just because of the Venezuelan situation, but that could also wind up being more of a theme as the rig counts have gone down. And then beyond that, of course, Julia, I know we've talked so much about the vanity trade, but I still think that may be one of the hottest themes, and biotech in general, but looking at the diet drugs and looking at some of the consumer habits that occur because of the fact that there's been a lot of weight loss. I still like semiconductors and some of that space. I'm looking more into other types of more infrastructure aspect of that. I mean, you can't, of course, discount Nvidia, but even cloud computing coming in, or some of the other type of infrastructure plays like Hut, for example, or Teradyne. And then beyond that, really, I'd say those are my main, but robotics, I like Serve. Obviously, space now is back hot. And energy play, I think nuclear had a nice sell-off if you're looking at uranium, and that could come back as well.
A long shopping list for people to look at for next year. David, I want to bring you into this because I'm curious for you too. Are you is there anything that you're sort of adjusting in your screening process for next year, given what you're expecting?
Yeah, well, really what I try to figure out is where are the layup bets? Where are the things that are almost definitely gonna happen because they're already happening? So I guess there's a few areas where I'm looking for that. One is these secular growth stories. It's a little confusing what's going to happen with the big picture, but an area like healthcare, for example, doesn't change as much with economies. So if you look at a company like an MEDP, for example, they're a CRO. They make it much easier for
CRO.
Yeah. So what they do at Contract Research Organization, they help biotechs go through the process of all of the FDA trials and facilitate those processes, and they do it at scale for many companies, which makes it cheaper, makes it more efficient, makes it just a much more efficient process. And it's a great margin business, and it can keep growing. So that's an area I like.
Gotcha. And then Transmedics is another one in the medical, obviously, category. Why that one?
Well, Transmedics is a really cool business, especially if they can accomplish their end mission, which is to create this end-to-end full ecosystem for organ transplants. Organ transplants had high failure rates. The transport hadn't been very efficient. Sometimes they just have to throw out perfectly good organs because they weren't transported in a safe way. They're building the whole ecosystem from point to point and making it a far better system. Their company is growing exponentially. Clearly, someone is willing to pay up for an organ that works and have their transplant work. It's pretty much, real life or death. So I think Transmedics could be a huge growth story over the next few years.
Yeah, it's interesting that you guys both have sort of medical picks, but in different areas. I mean, just one quick follow on Transmedics. The stock, doubled this year already?
Oh, yeah.
So I understand the appeal of finding something that works that you think will keep working, but at one point, does that sort of thesis get priced in, or do you get concerned about that?
When the earnings don't keep up. But when you look at Transmedics, their revenue growth has been exponential, their earnings growth has been exponential, so it's actually not getting baked in the sense that they keep putting up consistent exponential revenue and earnings growth, and there's no reason to think that's going to stop as long as they can actually create that end-to-end system for organ transplants.
Gotcha. Mish, I want to come back to you on one of your medical picks, which I believe AbbVie is one that you've liked for a bit here. That one isn't one, I don't think they're in the obesity game as far as I know. So what's the thesis there?
Well, twofold, really. They're not in the obesity game per se, but there is Botox, right? And that has become more and more popular and will continue to become more and more popular as a means to deal with skin issues that happen when you lose a lot of weight. So that's more in the vanity area, but it also obviously does a lot of immunology. So yeah, AbbVie had a really nice move this year in 2025 to the point of, can it go higher? It's been in this massive consolidation right now between 220 and 228. And I think this has a lot of potential to make much bigger highs as we go into 2026. And picking up on David's point, right, I like some of the other type of stocks that have done more antibody drugs like Replimune, and also ADCT is another one that's working on immunology through antibodies, which is a different way to treat disease as opposed to just dealing with the symptoms of it. So all of these are very exciting for next year.
And Novo Nordisk is one that obviously that one is in obesity, very much so. But of course, it's sort of fallen behind Eli Lilly. So do you think this will be a comeback year for them?
Well, this is where I think, Julie, I mean, you can't deny the company has a real future, but you got to watch price on this, right? You look at Eli Lilly, well over 1,000. You look at this, it's hovering around 47, 48. It can't really seem to get back over 50. So I think if you see a breakout over these more recent lows over the last couple of months, that is an indication that things are starting to improve.
And David, just finally to you, healthcare in general, do you think that, I mean, we've talked to a lot of investors who say they think it's going to come back and sort of outperform more next year. Do you share that broader view?
I do share that more broadly, but I think especially in healthcare, it's very important that you pick your spots because I think health insurance companies might be a bit under pressure. The benefits that they got from the enormous subsidies from the ACA aren't necessarily going to be there in the future, whereas these companies that are more the picks and shovels that facilitate the system of healthcare, that can pass through price increases for absolutely necessary mission critical services, I think those are the places you really want to own in the healthcare ecosystem.
Ted, always great to see you. So maybe start high level, Ted. You know, we look at the tech sector, the AI trade and trend, as you know here, big winner in 2025. I guess now what, Ted? What do we expect in 2026? What do you think risk reward looks like, given where valuations are at?
Well, Josh, Happy New Year, by the way, and thanks for having me. You asked the right question, and right now I think if you look at 26, we're going to have a tremendous amount of volatility. The AI trade is very well understood, at least through my client base. With you look at the infrastructure build really outpacing enterprise adoption, and that's the issue. We're going to spend at a 40% clip here for the next couple years. The SOX is up, the semiconductor index is up almost 48% year to date. And if you look at the IGV or the software index, that's been the big laggard, only up 7.8%. So all I think of this is understood. As we look into 26, there's three issues that I'm looking at very, very closely, and we can go into that if you'd like to.
Yeah, I'd like to go into that. And maybe, Ted, on that point you just brought up, I just want to drill into that. This mismatch, as you say, between the data center build out and the real enterprise AI adoption. When would you expect, Ted, then to see that enterprise AI adoption story play out? Is that a 2026 story, Ted? Is it 2027? What do you think?
Right now, it's hard to nail down, but I don't think it's 26. The enterprise, there's only roughly 30% of the global 2000 that's ready to move to Gen AI. 70% is still going through data cloud migration and data cleansing to get into an LLM. So we've got, enterprise, it always takes so much longer than the street is looking at. That mismatch probably goes into 27, 28 is my guess.
And what are the signs and signals, Ted, as investors I would be looking for to say, okay, now we're really seeing AI monetization, not just AI marketing? I mean, am I looking at software spend? Am I watching the cloud businesses? Like, what should I be looking for, Ted?
I think it's well understood that the cloud titans are going to see it in token growth as well as just their overall cloud growth. Where I think it's really instrumental to see enterprise adoption is via your last few guests is in the software area, specifically on the agentic plays, whether it be, a CRM, a ServiceNow, a HubSpot, and then the whole security sector is moving to AI. I think if you see robust net new ARR, that's going to be a very good indication of enterprise adoption.
Another theme, Ted, I want your take on, what you wrote about, was obviously the massive capex by tech giants. But of course, we've seen these concerns creeping up, at least with some names, Ted, financial stress, debt loads. And I'm just curious how you're thinking through that dynamic.
Well, my clients do not want to play names that are negative free cash flow. This is one of these cycles because of this mismatch in infrastructure. It's very capital intensive on this infrastructure build. So the only real names that really have the businesses behind it to really fund the capex is Microsoft and Google, and that Google's up 87% year to date. So with that, I think there's a propensity to just watch and have some dry powder. I don't have a lot of interest in some of the negative free cash flow names at this point. And it's obvious, I think, as we go forward that you're getting indications that whether it be Anthropic or whether it be OpenAI or SpaceX, that the debt market is tapped and it's not big enough, quite frankly, to fund the infrastructure build. So all of these next generation companies are going to have to tap the equity market. And my worry there is very simple. After doing this for a few decades, is when you have 4 or 5 major tech companies that have to raise just a boatload of capital, OpenAI has been rumored $100 billion. My worry is that we get some time in 26 where all these guys come public at the same time and we drain, quote unquote, the equity liquidity lake, if you will. And my PMs are going to be forced to sell some of their winners to fund some of these positions in these new companies.
Another theme you call out, Ted, rising component costs, memory, networking. How concerned should investors be about that, Ted? What could that ultimately mean for margins, for end demand?
That's a million-dollar question right there. I think it's under everybody's radar screen. I listen to over 70 conference calls during an earnings season and try to stitch together tech. And for some reason, this is under the radar screen of most. And if you look at the Micron report last week, DRAM, which is really the high performance bandwidth memory that goes into data centers, that ASP, their ASPs were up 20% sequentially for DRAM last quarter. That's a lot of pricing leverage, but in my career, I've not seen ASPs up this amount. Then you listen to the Dell call and, a lot of people are not out of their silos. They need to look at tech from a broad sector standpoint. The CEO of Dell basically, in a nutshell, said, I've got enough components for Q4, but I'm going to see shortages and I'm going to have to raise prices because of components. I think where the street really needs to now focus on is names like in the PC supply chain and the handset area. They're just not going to be able to get a lot of required memory for their products because the AI spend is so dramatic. Now, with these prices up, I think you're going to see a lot of elasticity of demand.
Finally, Ted, I want to just switch gears here hard. But given your background, Naval Academy, naval aviator, Ted, I thought of you when I saw this. I just wanted your take on this news. Chinese government sanctions 20 U.S. defense companies. And apparently, Ted, this is retaliation for Trump's, approval of weapons sales to Taiwan. I'm just curious, given the background, what do you make of that headline? I mean, American defense contractors not doing a ton of business, of course, in China. So what do you make of it? What was the point and purpose of that, do you think, by Beijing?
Well, the street discounts the whole geopolitical area, which is really a red herring going forward into 26. If you look at the China and U.S. relationship, if you don't get AI right, you're gonna risk your economic development and defense. The defense area is all pivoting, whether it be drones or related AI weaponry. The defense budgets are shifting very, very quickly on a dime to AI. So when we look at this sanctioning on both sides on entities that they view as competitive, this is really economic warfare at its best. And it's discounted. It hasn't mattered in years, but it's going, as we really go on a collision course with the overall China economic and defense standpoint, I think it's going to become much more of an issue in 26 and 27 if it gets out of hand and we don't go back to kind of this mutual insurance on the trade side. Unless we can find a happy medium, we're going to be entering some kind of new Cold War.
Ted, we're always so lucky to have you on the show. Happy holidays, my friend.
Yeah, Happy New Year.
Keith, I've been watching really all day long. Actually, it's yesterday, I should say, this Nvidia deal for Groq. And if you zoom out, I think it says so much about the mindset of companies and how the AI bubble, it may only be just beginning, despite all this AI bubble talk.
Sure, Brian, and thanks for having me. We're looking at it in a similar fashion. It's not necessarily a bid for a competitor. It seems like, and this is kind of what we've gathered from it, is it's a investment into capacity expansion beyond the current GPU platform that Nvidia currently has. It's an investment alongside of a competitor, in not only in the vertical they're in, but also looking at it from an aspect of just a capacity growth that seems to be, this is a positive affirmation of that capacity growth that grows beyond what Nvidia currently has in their vertical. So this is, in our opinion, a very positive checkpoint for where we are in the cycle. There's a lot of questions about where we're in the cycle and infrastructure build and is it overpriced and have we gotten ahead of ourselves. Nvidia, with this investment, in our opinion, is saying no, we haven't. I see a lot to come in this investment phase.
And I got to give a shout out to one of my ex-followers here, law watcher of the show, Sideline24. One of my resolutions, Inez, was to go out and visit an AI data center. This user telling me they have, he's working on a project out in Arizona to build an AI infrastructure plan. So it's fascinating to see what's happening in this country because of AI. And there's a question to you on this, which I haven't seen brought up a lot on this Nvidia Groq deal. Was Nvidia potentially at risk at losing its number one spot, not today, not tomorrow, but let's say 5 years down the line to a company like Groq, and they figured, why not just pay big now, shell out a big check, and then nobody could touch us?
You know, Shazi, I was listening to an investor of Groq on his channel about why this is so interesting. And this is basically what he was saying is that NVIDIA is seeing the writing on the wall when it comes to specialized chips, because you played that sound of Jonathan Ross talking about the inference technology that they have. And this is where some are seeing that where the money is at with these specialized chips, and why NVIDIA would pay 3 times the value of this company. And by the way, Jonathan Ross is seen as an engineering genius within this industry. So yes, it may be that the NVIDIA chips, which are generalized chips, which are good at many tasks, are great, but now where the money is being seen going forward, where the reoccurring money may be, is in this specialized chip space. And that's why they are essentially buying this company in this deal that, by the way, is this licensing deal, which is an interesting also format for these. Now we are seeing more and more of these types of deals where the talent goes to now NVIDIA, where the company is still sort of more of a shell company, and this is because of antitrust issues to make sure that this goes through. But yes, Jensen Huang may be admittedly saying we have a great chip, but now we are acquiring this specialized chip with Jonathan Ross, did the TPU over at Google. So it's definitely seen as where the market may be going.
And I should mention, reach out to Groq. They declined to make Jonathan available for an interview. Keith, let me get back to you here, because really next year, you're starting to get the sense, if we haven't gotten it already, some of the world's largest tech companies might go hunting in private company land. You know, the companies that have been raising money all the past 2 years at big valuations, they may go shopping to further boost, their capabilities. What do you think about that?
We absolutely think that has to happen in order for the story to continue to evolve beyond where it has started with the quote unquote picks and shovels over the last couple of years. We feel like to justify the valuations, the story has to continue to evolve in the spaces that we just haven't really grasped yet, in particular on the private market side. But we've seen some developments on the private credit side as far as the funding that have drawn some questions as to kind of how far this can go and how it will be all capitalized. So in 2026, the story has to continue to evolve away from some of the main culprits of the last 2 years into spaces that the market really hasn't appreciated the AI story to evolve to just yet. So we're looking for that evolution, and we feel like it has to come to justify valuations going forward.
Keith, how willing would you be to get outside of the Mag 7 and some of these big cap tech plays and get involved in the broadening out of the AI trade? And I'm even talking about something as companies that make concrete, companies that make steel rebar that are helping build these, put up these AI data centers, electrical power companies. Are you comfortable taking it to that level yet?
Sure. In our equity strategy, we've been taking it there for the last over the last year or so. Yes, we're looking at spaces, particularly in industrials, in that also in the utilities as well. Ancillary plays to the AI adjacent names and stories and industries that benefit from this build out, which might not have as much built in their valuations, also might not have as much debt or risk associated with this current trade. So we're looking at all those spaces that we can have a cheap entry into investing in this next phase of the build out that we feel like 2026 is really going to start to embrace more outside of the Mag 7. So we're absolutely been looking in those spaces.
Maybe we'll start at a high level, Brennan. You think about that U.S.-China relationship. I'm curious, Brennan, as we now roll into this new year, into 2026, over the next 12 months, Brennan, how do you see that relationship evolving, Brennan, and what do you think it means for the Chinese economy, Chinese equities?
Yeah, I think first and foremost, happy holidays, Josh. Thanks for the opportunity. I think 1.4 billion people in China wake up every day not thinking about the United States. They're waking up thinking about China's economy, and I think they're going to take the lead off. We've got the draft of the 15th five-year plan was released in October, really emphasizes domestic consumption and technology self-reliance. That's been followed by the Central Economic Work Conference, as well as more recently, President Xi released an article in a magazine talking about domestic consumption. So we as investors, we know, similar to investors in China, that's the two areas we really want to be focused on in 2026, domestic consumption and technology.
Let me ask you about the K-Web, Brennan. So we're up around 20% this year. How would you generally characterize valuations here?
So the K-Web companies are really offshore Chinese. So these are Chinese technology companies listed in Hong Kong. Those companies are very, very undervalued relative to their U.S. counterparts. These are companies like Alibaba, Tencent, JD, Meituan, Trip.com, et cetera. So we still think there's a real value opportunity in these technology companies listed in Hong Kong. That is going to be somewhat dependent upon foreign investor flow, something that we've seen start to percolate in 2025, which we think will continue next year. Based on some of the things you've been talking about, weaker dollar, that's kind of forcing some foreign investors out of U.S. equities potentially into growth stocks listed in Hong Kong like we hold in K-Web.
Brennan, there was this new report in the Journal. I want your take on it. I don't know if you saw this one. I'll read you the headline. It said, China's sprint for tech dominance can't hide an economy full of holes. The article is about how China is closing the gap with the U.S. for global tech dominance, Brennan. But the Journal goes on to say here, big parts of its economy are a mess. Their words. Curious just to get your take on that, Brennan. Does that kind of align with your view?
Not necessarily. I mean, I think no one's going to say that it's all rainbows and unicorns in China today. At the same time, they're growing at 5% GDP growth, so it's not all bad either. As well as I think, Josh, if you think about this narrative that China's going to fall off a cliff, I mean, how long have we been hearing that? I mean, how long have we heard China's about to invade Taiwan? I mean, Taiwan, it's been 76 years. That's 27,740 days China's not invaded Taiwan. So I think at some point, investors need to become a little skeptical about some of this always negative media reports and basically look to resources more data-driven like we tried to provide here at Crane Shares.
Would you expect next year, Brennan, do you think that the CCP, would you expect Chinese authorities to offer and inject more stimulus into that Chinese economy next year?
I think we'll continue to see targeted stimulus. We're not expecting any bazooka-style stimulus. like we saw arguably in September of 2024. But I think you're going to continue to see support for around domestic consumption. They do a lot of subsidies. They obviously want to avert a housing crisis, so a lot of attention played there. But then I also do think maybe a little bit of a sleeper is, could we actually see better U.S.-China relations with a Trump-Xi summit coming in April, as well as the APEC conference is actually going to be in China in the fall of next year. So you arguably have multiple opportunities for Trump and Xi to meet. And I just really believe that maybe the market underestimates the potential for better U.S.-China relations.
Why, Brennan, speaking of U.S.-China relations, why do you think Trump decided, you know what, he's going to allow Nvidia to export those H200 chips to China? I mean, was it because, okay, Uncle Sam's going to get a taste, Brennan? Is it because Trump thinks, hey, for now at least, Xi has leverage when it comes to rare earths? What's the reasoning there, do you think?
I think President Trump, he's not a career politician. He's been a business person, and I think he looks to corporate leaders as almost like a shadow cabinet, where I think he wants to meet and hear the views of, if it's Tim Cook or Jensen Huang or other corporate leaders. As we've seen earlier this year, that after the CEOs of Walmart and Target and Home Depot met with him, the tariffs were kind of de-escalated. So I think President Trump is unique in that he does listen to corporate leaders, and I think Jensen Huang, arguably said, this is really, really critical for Nvidia. But at the same time, I also think Chinese companies want Nvidia chips. So why would you turn your back on that revenue opportunity?
Well, and here, Brennan, on this great AI race, AI hardware, AI software, who, in your opinion, Brennan, still is in pole position, still is in the lead? Is it the U.S., and if so, how long do you think?
I mean, certainly, using Nvidia as Nvidia is very, very far ahead of its Chinese equivalents. So I don't think there's any catch up on a Blackwell-like chip coming from a Chinese competitor anytime in the near future. I think the two countries, and really ultimately the underlying companies, are looking at AI very differently. In the U.S., it's really about an enterprise sale from Anthropic or OpenAI, really. In China, the large language models, those are open source. They're literally basically free. There's no moat to a lot of these large language models in China. Where the revenue is coming in is going to be on the cloud computing, and that's where Alibaba, Tencent, and Baidu really are going to be the main beneficiaries of AI via cloud computing.
Brennan, always great to have you on the show. Merry Christmas.
Yeah, likewise, Josh. Thank you so much.
2025 turned out to be quite the milestone year for Apple, and despite some turbulence, the tech giant has set itself up for its biggest change in years. Yahoo Finance's Dan Howley joins us now with news. Dan.
That's right, Josh. This was a huge year for Apple. Not only did they post record revenue, they sold their newest iPhone, seeing huge numbers as far as sales go so far. And oh yeah, they hit a $4 trillion market cap, the only other company to do that, Nvidia. And they're, kind of playing a little closer to Nvidia now than when Nvidia was at $5 trillion. But what's a trillion between friends, really? Some of the things that the company did, though, really didn't have to do with one of the biggest issues that they have, AI. That seems to be pushed off until next year. They did have their head of AI retire. They're bringing in more folks. They did see a number of other C-suite retirements, whether that was their legal counsel or their head of government affairs. And it seems as though, for the most part, what this is doing, as far as the year goes, is teeing up for a post-Tim Cook Apple. Now, there was that Financial Times report a month ago, basically saying that Cook was ready to retire sometime in early 2026. Then Bloomberg's Mark Gurman said that's not exactly the case. Regardless, he is approaching retirement age. And so the company is clearly thinking about what that would look like. And so they've reportedly been grooming John Turnus, one of their VPs of hardware engineering, to be the next CEO. He's the top contender. Doesn't necessarily mean he will absolutely be the next CEO, but he's being kind of groomed for that position. And really, Apple kind of giving us a sense of, this is going to be a transition transitional era, and this is how we're going to handle it, kind of piecemeal. As people kind of take off, we'll fill in those slots, but it won't be kind of a all at once approach. And for a company like Apple that's remarkably stable despite being so large, it can feel a little odd seeing so many departures at once or throughout the year. But the experts that I spoke to say this is really the best course of action for this company.
Let me ask you, Dan, Apple's engine's still the iPhone. In 2026, what do you think innovation is going to look like there? What could we expect? Is it form factor changes? Is it foldables or revamped Siri? What do you think next year Tim Cook has to introduce to keep that engine humming?
Yeah, I mean, the big rumor is that there'll be a foldable iPhone for 2026, and kind of the iPhone Air was seen as kind of teeing that up, showing off that they can put the goods inside of a smaller package. There's been different reports saying that the Air hasn't sold as well as, the Pro or the Pro Max or the base 17, which is a remarkably good phone for the price. But it appears as though that is what the Air was, kind of an appetizer almost, and the foldable will be the main course. Now, there's been obviously Samsung with their own foldable phones over time. They have their Fold 7, which is an incredible phone for what you get. It is priced relatively high, and you can imagine that a foldable iPhone would probably have the same kind of price premium. So, for the iPhone itself, that's kind of what we're looking for in 2026.
Dan, great to have you as always. Thank you, sir.
Thomas, what has surprised you this year on the AI trade?
Well, I'll tell you, Brian, it wasn't a surprise for us, but I think it was a dramatic surprise for the market and may still surprise some people when they hear it right now. The number one performing AI stock for 2025 was not Nvidia, it was Intel. Intel was up, as of yesterday, 81.4% year to date.
Intel's still around, Thomas. They're still around. They still do business?
They still do business, and the world, all of the chip designers are dramatically dependent on them succeeding in developing advanced chips. And the US government is standing behind that because we don't want to be dependent exclusively on Taiwan Semiconductor. So Intel was the number one chip and hyperscaler, followed by AMD. So Intel was up 81%, AMD up 77%, Nvidia up 36%, not bad, but less than half of the returns of Intel. Microsoft only 15%, Apple 8%, Amazon 4%. So I think people were a little surprised that the most popular names were more subdued than expected. And I do think that theme is going to persist, but we'll get to that.
Angelo, hit me with a surprise. I think that Intel move, the fact that it's outperformed Nvidia, certainly has surprised a lot of folks. What's been on your radar?
Yeah, I think one thing that may surprise many of your viewers is that valuations for the tech sector are lower now than what they were at the start of the year. So basically what has happened is that earnings have been growing faster than prices. So that pushes back against all that AI bubble narrative, because it is really earnings that have been doing the heavy lifting for the tech sector. And that, I think, is a comforting message. Yes, tech is the most expensive segment of the market, but it has been able to deliver earnings, solid earnings. And what has happened late in the year is probably a healthy pause, but the AI theme is likely to continue.
These are the surprises I needed. Tom and Angelo, you have clearly brought your A game here on Christmas Eve. Tom, back to you. I think Angelo makes a very good point on valuation. So, question to you, are AI stocks still cheap then?
I think that we have to be a little bit careful as we look into 2026. I think the theme is not going to be the AI stocks or the AI cost centers, rather, when we think about hyperscalers and some of the chip names. The theme for 2026, and the biggest surprise, is going to be AI beneficiaries, those that are implementing the technology into their businesses to improve productivity, to improve margins. And to Angelo's point, earnings have grown. But if we look out 3 quarters, it's expected that the earnings growth rate of the Magnificent Seven relative to the earnings growth of the unmagnificent 493, we could say cost centers versus AI beneficiaries, is going to converge, meaning the unmagnificent 493's earnings growth rate will be equal to or greater than the magnificent 7 earnings growth rate by the third quarter of this year. And that's why I think we're going to see, as we see in midterm election years, the indices a little bit more subdued, a little bit more choppy, a little bit more volatile, because the biggest weights of the S&P 500 are probably going to take a breather or consolidate their gains as that earning growth decelerates. The other thing that we have to keep in mind here, Brian, is that CapEx as a percentage of operating cash flow now for the hyperscalers is exceeding levels of big oil. Greater than 60% of operating cash flow is now going to CapEx, and that's part of the reason that that growth rate is declining. And I think we're going to see a lot of money made under the surface in individual stocks, the AI beneficiaries, and maybe more subdued returns again from the AI cost centers, aka hyperscalers, and the stocks that most people are crowded into at the moment.
Angelo, talking about subdued returns, this year hasn't been a great year, relatively speaking, for Meta and Amazon, but Amazon in particular up only 5%. I mean, that's an ugly performance versus the S&P 500 and the rest of the Mag 7. If in January, would you be inclined to buy these AI laggards like a Meta and Amazon?
I think our call for next year is rotation both within tech and outside of tech. It is interesting that 4 of the 7 Magnificent 7 names have lagged the S&P, but that's followed multiple years of very strong outperformance. So I think some of that rotation is healthy. We are seeing potentially the early stages of the move from the companies that really enable and facilitate the build out of AI towards the companies that are adopting it. And I think that's going to include a broader set of opportunities for investors. And that is beyond tech as well, thinking about industrials, healthcare. These are some sectors that we see potential benefits flow through. But I think the name of the game is diversification, not concentration in 2026.
Tom, tell me if I'm totally off base here. So you have the Fed cutting rates. Maybe they come in with one more rate cut early next year. You have a whole class of people that have been making bank off of CDs, low risk investments. Are they now forced back into this market to earn a good return?
They are forced back into the market, but guess where they're forced back into is probably one of the most unloved areas of the market. As a matter of fact, dividend payers are the most out of favor and lower relative valuation than they've had in 25 years.
That makes no sense to me, Tom. I mean, we're supposed to like dividends. We're supposed to champion dividends. We want this check coming to our mailbox every quarter.
Well, there's no question. And exactly to your point, as the Fed cuts and that free interest payments on those money markets goes down, they're going to be forced to find the yield elsewhere. That's going to be dividend payers. Now, what is dividend payers? Where do you find the dividend payers? Well, you tend to find them in defensive stocks, consumer staples, healthcare. Some of the stocks now, if you look at healthcare in particular, lowest weighting in the S&P in a handful of years, lowest relative valuation to the S&P in 25 years. I would say right now is a generational buying opportunity in the healthcare sector. Oh, and by the way, in midterm election years, healthcare dramatically outperforms the indices. Since 1950, the S&P tends to be more subdued in midterm election years, about 2% returns. Well, guess what? Healthcare does over 9%. And the last 3-4 years, you couldn't give healthcare away. So expect good things from healthcare for a couple of reasons. One, the dividend yields. 2, it tends to do well in volatile periods. And 3, I think it's going to be one of the major AI beneficiaries, not cost centers, aka they're going to use AI to lower costs, increase productivity, and in a material way in drug development. So healthcare is the name of the game for 2026.
Angelo, next year, is that the year of the dividend?
I think it can have improved performance relative to the other years. We like mid caps as well, thinking about asset classes. Mid caps, some international, still emerging markets. We talk about AI and technology, but there's a lot of innovation also happening beyond the US borders. And as you talked about the Fed and slightly cutting interest rates next year, that gap now between cash returns on CDs, money market funds, and either you talk about fixed income or dividend-paying stocks, that gap is going to widen. So we could see some rotation out of heavy excess investments for many investors into cash towards other asset classes.
Tom, real quick, do you chase gold here?
No, we like productive assets, but just to jump on what Angelo said, he pointed to mid caps. Well, look at the earnings expected growth rate of the S&P at 14%. How about small caps? Expected earnings growth of 55%. They're just coming off the mat. I think you can get a lot of bang for your buck in 2026 in small caps as well.
Circular financing. It's a fancy way of saying OpenAI is at the core of most big AI deals. That means the pressure is on them to deliver on their bold ambitions, or it could put many tech companies at risk. Today, my Power Player segment is John Chambers, JC2 Ventures founder and CEO. He's also the former longtime Cisco CEO. John, good to see you. Always a treat. It's been a while. Welcome back. So let's start. You know all these players in the tech industry. I want to start with Oracle for a second because they report earnings. You know this company. You remember them from decades ago when you were competing with them in some capacity. How important is an earnings report from an Oracle at this stage in the AI trade?
So, Brian, first of all, it's good to see you. A little bit of report before we jump right in. I miss being on your show and look forward to seeing you in New York. In terms of the major players, whether it's the Magnificent Seven your prior guests talk about, or Oracle, Broadcom, obviously I'm not referring to the quarter at all. I tend to think for the year and 2 years out. I've learned a couple lessons. You never bet against the Fed. If it's lowering rates, you're probably going to see an up market. And don't bet against Larry Ellison or Hawk. And both of them, I think, are tremendous leaders. In terms of the players I love in this area, I like what Google's doing, and probably they've improved the most in the last 6 months on their hand. And then Microsoft, Satya's doing an amazing job. And then I like Lisa at AMD in terms of that group that I think are really making a difference there. But indications of what you just said, I would not look at one company as the bellwether. In the internet, that was fine, where Cisco had 50 or 60% of the business, and we often had the vast majority of every product category. But if you watch what's going on today, whether it's in semiconductors, whether it's in the software, the models, etc., you'll probably see a couple of the Magnificent Seven stumble over the next year or two. And I hope the market doesn't overreact to that. I think you need to look at the balance of the group. The balance will be up. But I think whether it's the Magnificent Seven or startups, you're going to see that mid-level group, several of them fall out at a fairly rapid pace, especially some of the smaller companies.
Who do you think stumbles, John?
The ones that I like to bet on Microsoft and Google. Mm-hmm. I think they're positioned well in terms of it. Nvidia, Jensen's a machine. So those would probably be my three that I like the best.
I've never seen a backlog like Larry Ellison has at Oracle. I think it was $455 billion. But the stock has been under pressure because of fears that they can't actually service that amount. If you were the CEO of top of one of these large AI companies right now, John, how would you finance some of these big deals?
Well, I think the money's there as long as the market sees it. Financing in today's world, the market, if they really believe in your strategy and the implications of it, the financing's there, and that includes for venture capital and startups. Financing, if you haven't got a good plan or concern, it can be a little bit more challenging. But the AI play, I believe, is real. I do not believe it's a bubble. I think there will be people that trip within that, and there'll be some train wrecks. But the AI play, we're just getting started on. I think 2026 will be a great year for AI. Productivity will grow faster than almost anybody realizes. I think the market's underestimating that on earnings. And I think many of the CEOs are just getting started on how they're going to use AI in a major way. It doesn't matter whether you're in retail like a Walmart, or an automotive like a Ford, or in healthcare or government. You're seeing AI benefits start to occur real rapidly. It used to be just in coding and customer service. Now it goes across all functions. So I think this is a decade-long phenomena, and I like the play of taking the top players, bundling them together. I personally like the hot startups, the companies I've been fortunate enough to be associated with, very much like what KR is doing at Bloom Energy, or what Bipple is doing at Rubrik.
Yeah, I just talked to Bippo last week. I mean, another big quarter from them, big IPO too. What, everything I've heard the past month, John, everybody's been so enthused with Gemini 3. And look, I mean, it's a powerful model. What Google has done over there has been tremendous. But is the market now underestimating the potential for OpenAI? And this company has huge, lofty ambitions over the next decade. They have a lot of commitments out there. And if they don't deliver, it's just not good for the tech ecosystem.
Well, first of all, I think it's very healthy to have two at least, and you prefer three players in a category. I think both those companies are going to do very well. I've been really impressed at how Google has moved, as I alluded earlier, in the last 6 months. And what you do with OpenAI, I actually did my 10 predictions for this year, and I didn't use any of the AI tools, but I went out and asked the questions on each of the 10. What did ChatGPT say, and what did Gemini say, and the odds of me being accurate on it. And then I said, what is the one or two area on each of the predictions you think that I'm most exposed on? The answers were amazing. So I think you've got two great tools. You're going to see people move back and forth in terms of utilization of them. And I think both of them are going to do fine. But again, just starting to see early innings of what this is going to produce.
Are you concerned that OpenAI is at the core of so many big deals? I mean, you mentioned AMD. I mean, they had a big deal, and OpenAI might be an investor with them looking out over the next 10 years.
Well, if you watch, what I think we've seen this time is normally the large players do not participate in the next generation of market movement. That was true of IBM, mini computers, client servers, the internet, software service, the cloud players. This time it's going to be exception. They're going to be there. And if you watch the model that we did at Cisco in the very early 90s, you do it yourself. You do it through acquisitions. I did 180 acquisitions, or you do it through strategic partnering. So I love the strategic partnering that many of the companies are doing. And actually for my startups, whether it's Nvidia or whether it's AMD or others, they're investing in the startups because they're driving their own core business, the implications. I think it's a very good strategy. It does show that if one company trips a little bit, it'll affect others. But I think in terms of accelerating the market, it'd be what I would do if I were in their position. And whoever wins the AI battle as a nation and as an industry will lead GDP growth, standard of living, et cetera. So I think it's a national priority, and I like it a little bit. It would be an understatement. I like their strategy. Do it yourself, acquire, strategically partner, invest. I think it's just smart.
Marianne, always a treat to get some time with you here. Take us through your thesis on tech stocks.
So they're still the leaders of the market. I still see them leading, particularly the semis. The semis really are the true leader of the secular bull market. But in our work, what we're seeing is that they may take a pause, or the word that we're using is a reset. Now, if you look, for example, at an Nvidia, it made a new high, but it was not able to hold its new high. It's been in a trading range for months. Now, either we're going to stay in that trading range or we'll get a pullback. And even if you look at the semiconductor ETFs, they're trading the same. So I think the leadership of tech takes a break. I do think we're going to get a pullback, a correction. But I'd be a buyer on the correction. Again, I still see them as leaders. But that's going to lead to volatility in 2026. And it's the midterm election year, and it's very normal to have volatility in a midterm year. So I'm just telling our clients to brace for volatility, to be fearless. You don't have to trade these. And if you don't own them, or if you want to add to them, you're going to get an opportunity in 2026.
Marianne, do you see that reset happening in the first quarter? And if you do, what is that? What triggers that moment?
Well, I think you're already in it. I think it's already started. And we got a really strong GDP report, and the market's not going to now like rate cuts. So, I think you've already started part of the volatility that we're going to see in 2026. So the other concern I have is earnings have been spectacular. And analysts didn't see the earnings right away. At least not all of the analysts saw the earnings right away. And now everybody seems to be on board. In general, the market is looking for earnings to grow 15% next year. And the market, maybe earnings can be up 15%. But if we don't meet expectations or the whisper numbers, the market is not going to like that. So I think that's another big hurdle that we're going to have in 2026 is can we beat these now high expectations in the earnings forecasts?
You've been bullish, Marianne, if I'm right, semiconductors since 2012. How is covering this space and picking stocks in the space different today than it was in 2012? Outside of just the valuations, of course, are a lot different, I'm sure.
Well, when I first started to like semis, there was no theme. Certainly not an
It's a
AI
great point.
story. So now we have a theme. Now we understand why semiconductors are no longer commodities and they're a growth story. So that's probably the big difference is now we have a major growth story under AI. And, Nvidia has, basically rewritten the path for semiconductor chips and the whole stack build out. And yes, you're going to have ebbs and flows. Stocks are going to go up, stocks are going to come down. But in general, I see tech leading this rally, and particularly semiconductors, out into the end of the decade, into 2029, 2030, and that would target the S&P up around 10,000 to 13,000. So again, that's why we're calling 2026, to be fearless, that there's still significant upside in this market, particularly for technology.
So you don't see an AI bubble?
No, I don't see a bubble at all. However, I do believe we're going to be going into a bubble. We've compared this market to the late 90s, 2000 period, and the bubble that we had in the 20s, in the 1920s. And we're tracking pretty similarly. In fact, it's kind of eerie how we're actually tracking that pattern. So I see a bubble occurring, but not out until maybe 29 into 30.
You know what I find eerie, Marianne? If you're right on the S&P 500, it hits 10,000 or over, whatever it is, do you think it will be still concentrated in these 7 Mag 7 names?
The way the market is trading now, I would have to say yes. What the market really needs is for companies to become public. And that's been one of the big changes to our market is companies are staying private longer. And that's really changed the structure of how many companies that we have in the public markets. When I came to Wall Street, there were over 5,000 listed stocks on the New York Stock Exchange. And that's almost now contracted to almost half of that. So it's pretty scary in the sense that we don't have as many. And that's not allowing the markets to broaden out because even though we have concentration in what we call Mag 7, you have concentration in almost every sector of the market. So it's the structure of the market has dramatically changed since I first entered Wall Street.
It sounds like you're still longer term bullish on semiconductors. If that's the case, and we're going to continue along this path of the AI revolution, what does it mean for software companies? I just had Dan Ives on with me a couple minutes ago. We were talking about software, Palantir, Salesforce. How are those big cap tech stocks that are not in the Mag 7, how are they impacted by this?
Well, it's kind of interesting because originally when I came into this year, I thought software could do well, and then all of AI happened, and then software has lagged. And I think software has to learn how to play in this new AI world. We're always going to need software. So I don't think it's an end of an industry, but they may have to up their game to play in an AI world.
Lastly, Marianne, I'm asking all my guests this week, what has been your biggest surprise in markets this year?
So I was bullish gold coming into the year, and I did have a 4,000 target. Now I'm not trying to pat myself on the back, but to be honest, I didn't necessarily think we would hit 4,000 this year. So what has really surprised me is not only the move in gold, but how now silver has broken out to a record all-time high and is in a new secular bull market. Copper has broken out to an all-time new high. We're seeing the whole metal space break out, and that has become extremely bullish for the metal stocks. And that is probably one of the biggest surprises. We now have metal stocks in a new secular bull market along with the metals.
All right, we'll have to leave it there. Marianne, big longtime fan of your work. Thanks for always making time for Yahoo Finance. Happy holidays.
Same to you.
So before we get to 2026, Joseph, obviously you want to talk about your outlook there. Let's just take a beat on 2025. What do you make of the year, Joseph? What did you learn?
Well, it was another great year. Averages now had 3 fantastic years in a row. I think that obviously the prevalence of AI, not just of the AI beneficiaries, but the spread of the impact has been enormous across the markets. And clearly that's been the dominant theme. Who are the winners? Who are the losers? Losers have obviously had a very tough years, and the winners have been fantastic stocks.
Let's talk about what's ahead here. With the SPX, if you look under the hood, it sounds like, Joseph, you're bullish on the 493 instead of just focusing on the Mag 7. Let's start there. Explain that. I mean, is that valuation, Joseph? Is it earnings growth, positioning? Explain it.
I think that there have been a number of businesses in the Magnificent 493 that are perceived as being hurt or compromised by the growth of AI. Valuations have gone significantly lower for a number of those companies, and businesses that are just not participants in the opportunity of AI have also not performed particularly well in that bucket of the Magnificent 493. And I think in 2026, what we're going to find is that many of these companies are harnessing AI to get better, to lower their costs, to improve the velocity of introducing new products. And those businesses will begin to get the benefits of that as people recognize it. It hasn't happened in the last couple of years, but I think we're going to notice that in the next couple of years.
Well, what does that suggest, Joseph, about what do you think I do with the Mag 7, though, in 2026? Am I avoiding those names? Am I trimming exposure? Do I have to be more discerning? Maybe next year, Joseph, it's more like, the Mag 3 or 4.
I think so. I think the Mag 7, it's tough to paint them with a broad brush because each one of them has a specific story associated with them. But I think just from a valuation perspective and the fact that they performed so well for such a long period of time, I think that some of them will take a break, some of them will perform well, but really the opportunities for outsized returns next year are going to be outside of those 7 businesses.
There was a story out there, Joseph, sort of a narrative that had built that, the AI trade and trend had better stay intact. If it doesn't, the market's going to come off its wheels. But having said that, recently you can look at, some poster childs of the AI trade. I think of an AI heavy name like an Nvidia. It's well off its 52-week high, Joseph, but this market has continued to grind higher. I'm just curious what you make of that.
Well, I think that it bolsters the thesis that the 493 certainly have legs. And I think more broadly, the economy is stronger than people thought it would be when we started the year. Rates are probably lower today than where we thought they would be. Inflation is probably a tick lower than we thought it would be. So the underlying conditions are somewhat better for the broad market, and the broad market has been able to weather, as you talked about, the bumps in the road that are inevitable with regard to the Mag 7 and the AI trade. So I think it's positive for the index as we enter 2026 that we've seen some level of broadening. And obviously we see opportunities in the defense sector, in healthcare, and selectively in technology as well as this rally continues to broaden.
Yeah, let's get to some of those specific names and picks, Joseph. You like Broadcom here, for example. How come? What do you like about CEO Hocktan's company specifically? Is the business model, margins, his AI story?
Well, our strategy is to invest in recurring revenue businesses, and Broadcom has one of the great technology recurring revenue businesses. When you think about how they're positioned with regard to AI, they're really very, very well positioned in a category where the product, the GPU, is 90% of the cost of the solution. And Broadcom with their XPUs is dramatically reducing the cost of effectuating the outcome that AI provides. And so we think that they'll continue to take market share among the hyperscalers, which is going to drive fantastic revenue growth in the AI business. We see the AI business doubling in 2026 for Broadcom, and we see it growing very, very rapidly after 2026. So long term, they're very, very well positioned with a product that is highly efficient for the customers.
And Joseph, you also mentioned you like healthcare. At a high level, what do you like about that sector, and what, in your opinion, is a smart way to play it?
Look, healthcare has been out of favor for the last 3 or 4 years. healthcare spending peaked in the pandemic, and a lot of demand was pulled forward for the businesses that we like. Those businesses tend to be the recurring revenue tools providers to the healthcare industry. Think of Thermo Fisher, think of Agilent, Mettler Toledo, provider of products into medical labs. And so those businesses are beginning to see better demand, and it's slowly getting better for those companies. And generally speaking, when things get better in healthcare, they stay better for a long period of time. So we see a very long-term growth opportunity among most of the healthcare industry, but particularly in the medical tool space.
And finally, Joseph, you mentioned you like defense. Now, President Trump, you saw this. He's been making some headlines there saying he wants these companies focused more on spending on new plants, not buybacks. Walk me through why you like defense, Joseph, and what, in your opinion, are some smart ways to invest in that sector.
Well, the big picture trend in defense is that European NATO spend has to go, basically is going to triple over the next 10 years. And so we're thinking about which businesses are going to benefit from that multi-year trend of growth in that end market. And so what we like are the recurring revenue aftermarket providers of parts to the defense industry. So we own HEICO, we own General Electric, and TransDigm, and all of them will be benefiting. All of them have about 40% of their revenues tied to the end market. All of them have very, very strong recurring revenue business models, and they're very well positioned for a number of years to benefit from that, what we think is a very long-term and durable trend.
Dryden, it is always great to see you. So let's start with that CPI print today. I'm interested, Dryden, what do you make of it? What do you think the Fed makes of it?
Well, I think it's good that we're beginning to see inflation come down as things are working their way through the economy. Everybody's been a little hypersensitive to that. And so now we're getting some data. Now people discount some of this data because they're saying, well, the shutdown, we don't really know. But I think what we're seeing is inflation's cooling. That gives the Fed the ability to look at that fourth cut, right? We were at 5.5, we went to 4.5, 4.5, now 3.75, let's get down to 3.5. That's going to be a 20% plus reduction in interest rates. That's going to be accretive to earnings next year. It's going to be expansive. So there is another cut. The question is, does it come early in the year or does it come after June? This allows it to come maybe January or early or during the first quarter. And I think that that's important because that'll be stimulative to the economy.
You remain constructive on equities in 2026. You call out monetary stimulus, Dryden, fiscal stimulus, productivity. Is there one of those variables that you say, okay, this one matters the most? Is there one that you think even now might be underappreciated?
I think what's underappreciated is the fact that because of the great big beautiful bill, right? You had two things going on and people have unappreciated that. We withheld really too much, right? So we have about $150 billion worth of over withholding from 2025 that's going to go into consumers in 2026 when they pay their taxes. The average person is going to get an extra $1,000 more back. Then when you look at the rest of the tax cuts, that's about $670 billion. So you have coming in as stimulus in the early part of the year, roughly $750 billion that's going to go into consumers' pocket. And we both know what does a consumer do when they get money? They spend it. So that's going to be constructive. That's going to be constructive to earnings. Most of the earnings look pretty good next year. And record earnings turn into a record market.
Let's talk about earnings. You did note here 82% of S&P 500 companies, they beat earnings in Q3, Dryden, you point out. So when you look ahead, what do you see for profit growth in 2026?
Well, the average, the Mag 7 are probably going to grow at about 18%, and we probably look at the rest of it around 13%. Those are most of the predictions. And the underappreciated thing here in earnings is as companies are implementing AI, you're seeing increased labor productivity. Increased labor productivity turns into higher margins. So I think we're going to have to see this implementation work its way through, but you're going to begin to see companies have margin expansion because of their adoption of AI because it increases labor productivity.
On Mag 7, you did point out here, you see growing earnings faster than the rest of the market, Dryden, but you did note here margin of outperformance narrows.
Exactly.
So, okay, does that mean, what are the implications of that? Should I be trimming my exposure then?
I think if you're way overexposed and you're in a taxable account, you got to pay attention to capital gains. But I think you look at positioning a little bit higher weightings to the 493 because we think that this earnings growth is going to spread out. There's going to be companies like we talked about here that are going to really take advantage of some of this margin expansion. So what's going to happen is Mag 7 does about 18, but everybody else begins to rise up and catches up to it. And I think that that's where there's a lot of opportunity next year.
I was talking to a strategist this week, sat in that chair. She was more cautious than you. And I said, well, hold on a second, you're cautious. And I said, monetary stimulus, fiscal stimulus, AI CapEx, right? She said, yeah, but you know what? A lot of that's now priced in, Josh. Do you see valuation risk?
Not as much as a lot of people. And
Why so, Dryden?
Part of this, everyone wants to say, oh, it's like the old .com bubble or something like that, right? Well, that's not true. The companies have real earnings, have real growth. These are large companies. If you take a look at Microsoft. Microsoft has 5 times the fixed assets as Ford. So you take these companies that used to be just tech and asset light, they now have real assets, real growth. That kind of puts even if you have a pullback in the market, all of this, the quality of earnings are better, the quality of the balance sheets are better. So when we have these moments of volatility, you have a backstop to it because it's real assets there. You have a backstop to it. It's real earnings. So I'm not we're constructive on next year, and we're going to hold to that. You have fiscal stimulus, you have monetary stimulus, you have all these things in alignment, and we think that that's going to be positive for the year.
What do you make of, listen, broadly when you look at that AI trade, you see some evidence that maybe investors getting some jitters are popping up, some nerves. But then you see the companies drying, like I broke Micron earnings after the bell. I did a double take on that guidance. I thought I had been reading it wrong, right? It was that much of a beat. That thing reported and surged, and it's this story of demand strong, supply tight. I'm just curious what you make of that.
We're in the infrastructure building period of the next new economy. This is like the Transcontinental Railroad, which transformed our entire economy with transportation stuff back in the 1870s. So when you look at right now, we're spending a tremendous amount of money. Not all the companies are going to be winners. You got to look at it one by one. But when you recognize the amount of capital that's going into this, we're just in the early stages. We're in the infrastructure stage. What's going to happen when we go to the implementation stage, where companies are now going to use this AI technology and all of this infrastructure to increase labor productivity and jobs? That's really going to push earnings, not just for the Mag 7, but for the entire economy.
Let's end here before I let you go on some picks, Dryden. Got 3 here. Amazon, GE Aerospace, United Rentals. Is there a common theme or themes for those 3 names?
All of them have to do with what's next, okay? For Amazon, obviously 4 out of 10, every $10 goes through the Amazon platform. They're absolutely dominant. So the common theme is all of these companies occupy a choke point in their business. So Amazon is online shopping, we shop more than we do anything else, right? So 4 out of $10. They're getting that, and we're going into Christmas, right? So they're dominant at that choke point. They're going to move. When you look at GE Aerospace has, in some of their components, 10 years of a backlog in making aircraft engines. We're going to continue to fly. Every plane's got at least 2 engines, and most of them are going to be GE Aerospace. So you're going to have the CFM. So you have about 80-90% of the Neo, about 100% of the 737, and you have these huge backlogs. So they got a 4-year backlog of total earnings, already orders on the books. They've got 10,000 engines for the CFMs on, and so they're dominant. You're not going to be able to fly without GE engines. So that's going to move forward. And then the third piece of this, when you look at URI, the roads and bridges in this country are deteriorating fast. We have to replace them. About $1.2 trillion worth of. You take the deficient bridges in this country and you line them up end to end, they stretch from Seattle to Las Vegas. It's 1,100 miles of them, right? And so when you look at that, we got to rebuild them all. Well, URI is a dominant rental into heavy construction. You got to have equipment. Not all the companies own it. They're going to rent it to it. They have a 17% market share there. They're the dominant player. So they're going to always be who everybody's renting from for the equipment that's necessary for the next bit of industrial build out of America.
Dryden, always great to see you, especially on set. Thank you, sir.
Thank you, appreciate it.
We've been trying to follow the sort of day-by-day developments in this AI arms race. Reportedly OpenAI declaring a code red recently because of the increasing market share of Gemini. As an investor, how do you know where to look, what to pick? Do you just invest in it all? What do you do?
I think you do have to have a core exposure in all of these companies because it is an AI arms race, and a lot of these companies, their businesses are good. But we do feel that at this point, they've run up a lot. They're trading on expectations of the business that they're going to do 5 years from now. And we feel that a pullback in the market is imminent. And these are the companies that are going to get hit the most when the market does pull back. So we've been talking to our clients about the leadership in the market changing from the AI winners to the AI enablers.
Okay, I want to get to that in a minute, but I do want to ask you about this latest headline that we got about Microsoft, the information reporting that Microsoft is lowering its AI sales quotas. And this brings me to the question I was just discussing with my colleague Dan Howley, which is not just where's the adoption going to be, but where is the money going to be spent, which kind of speaks to your AI enablers versus, who's putting it out in the world. Where is this money going to be spent? Or do you look at where it's being spent now?
Yeah, I think we think that a lot of it is going to be spent on data centers because a lot of this money, the AI-related data centers, we expect that by 2030 are going to triple and globally. And we feel that north of $7 trillion is going to be spent globally on AI-related infrastructure. So companies that are involved in building and maintaining those type of data centers and the infrastructure companies, that's where we are seeing more value right now.
Well, but I guess my question is, we know the money is planning to be spent on those data centers. Eventually, you got to bring in more revenue to fund those data centers. Now, the hyperscalers that are out there now, the Alphabets, the Microsofts of the world, they have lots of cash to do this. And they are starting to make some revenue related directly to AI.
Sure.
But especially the likes of OpenAI are going to have to make a lot more in order to continue to fund that $7 trillion that you're talking about.
Yes, and that's where we think the risk is, right? Because a lot of them are trading based on expectations that they're going to draw in that profitability. But we just feel that at this point in time, and then also what we are seeing is that a lot of them are benefiting from that bonus depreciation in the big beautiful bill, which is pulling forward a lot of that capital spending. So the balance sheets are looking really good now, but when the time comes for the show me, like when the revenues are coming, that's where we think there could be some vulnerability in these names.
Okay, so as you say, look at the infrastructure builders now, and you're not talking about an Nvidia, for example. You're talking more about the actual physical stuff. I mean, Nvidia makes chips, but the buildings, if you will.
Yes, absolutely. We are talking about like the brick and mortar companies. So if we believe that AI is real, which we think it is, then we have to invest in the companies that build the infrastructure that makes it possible for AI to exist. So we are talking about construction, equipment, utilities, electricities. These type of companies are necessary for AI to do well.
What do you think about this now what's become a sort of new battleground about electricity prices, which in some jurisdictions, the data centers have been pushing up those prices. How is that push-pull going to work out for the companies that are trying to build this infrastructure?
I think a lot of these companies, because the prices are going to go up, there's a lot of demand for this. So a lot of these companies are going to really benefit from it as well. And we've talked about this on the show before. We've been investing in utilities. We've been overweight that sector for the past 2 years. And they are a direct beneficiary of this AI build out because electricity is going to be needed.
Right. Okay. So other than that, I am curious where you're looking for opportunities. We've been talking a lot about Bitcoin recently, so I'm curious how you're thinking about that in terms of how clients should be positioned.
Yeah, in terms of Bitcoin and clients, I think we view it more as an asset diversifier, right? Like for us, one of the best investments so far has been gold, right? Gold, we've been consistently investing in that. That has been one of the best performers this year, up more than 50%. Similarly, we view Bitcoin. And I think this sell-off in Bitcoin is possibly an opportunity for those that missed out on the rally to get involved. And an easy way to do it for our clients is that Bitcoin ETF, IBIT, we have exposure there. And a lot of the sell-off is probably driven by potential unwinding of the Japanese carry trade where risk assets are being sold. So I think that's an opportunity to position into an alternative asset class for clients.